Welcome to this Killick Explains video on hidden costs. This is part 1 of a 2-part series, so part 2 will follow. This one is going to focus on a particular aspect of hidden costs and we'll worry about the other aspects later on. Now the background to this is what? Well, in a nutshell, charges can seriously damage your long-term wealth. For example, if you're making 5% per year, that is not guaranteed, it's simply an illustrative figure. You might make more, you might make less, gross before fees, and fees are 2% per annum. The net return annually is 3%, and the cumulative drag can be quite significant, because in pound terms over 20 years on an investment of £30,000, let's say, that reduces your closing balance by around 40% or over £40,000, and that's a very simple example. In real life things can get more complicated when it comes to charging structures. Now, where do fees and charges bite essentially? I'm going to take on in a moment bid to offer spreads. However, there are other areas too. There are fund charges, which I'll deal with in part 2. And then in part 2, I'll tell you where you can find a video that deals with advisor fees. And that's a separate video. So you've got 3 potential sources of costs that can really drag on your overall investment returns. So let's take bid to offer spreads first. Now, some apps, for example, will claim you can trade for free, but do they really mean it? Perhaps they mean that commission rates are low or even possibly zero, but are they talking about all costs? And in particular, are they talking about the bid to offer spread that attaches to most share transactions, a lot of fund transactions, and also most bond transactions? And the answer is probably no. So we need to make sure we've got a picture that builds in all costs rather than just a selected few for the purposes of marketing. And here's the point: when you buy or sell a share, the mid-market price you're quoted may hide quite a large spread, and that spread in turn will reduce the overall profit from a transaction or increase the loss if things go wrong. Now, how do spreads work? Well, in a nutshell, there are 3 prices quoted potentially for any stock. Normally the mid-market price is the one you get told about, but then you need to make sure you find out about the bid price and the offer price. In other words, there are different prices at which you do a deal to buy shares or sell shares, and the mid price is simply the average of the two. And the point about the mid price is it's purely indicative. It won't be the price other than by pure coincidence you can actually buy or sell shares at, and that has ramifications for the amount of profit you might expect to make from a trade. Now, by way of an example, let's take a look at a share with a quoted price of £2. That is the mid-market price. What does that mean? Well, the spread is 20p. What does that mean? It means essentially if you want to buy the shares now, you'll pay £2.10. If you want to sell them, you'll receive £1.90. And the gap between those two prices is 20p. That's the total spread. The mid price, simply an average of the two, is £2. So let's have a look at what that means for someone buying and selling the shares in the relatively short term. So here's the impact of what I've just said on potential total returns. The share price rises to £3. So it was 2, the mid-market price. It's now 3, with the spread still at 20p. Having bought at £2.10, remember factoring in the spread, you'll be able to sell at £2.90. Factoring in that spread, and that's a profit £2.90 versus £2.10 of 80p, and that's rather less than the £1 profit you might have expected to make buying for 2 and selling for 3. In other words, the bid to offer spreads have significantly influenced the amount of profit you take away compared to the quoted mid-market prices. Now, things to note about spreads. So first of all, they vary. The less liquid, that is the frequency with which something is bought and sold, the less liquid an asset, a particular share, the wider that spread will be. It could be more than 20p. Equally on more liquid assets, it could be less. They change, they widen or narrow depending on what's happening in the market. So they're dynamic. So the 20p spread I mentioned isn't necessarily guaranteed to be the 20p spread when you come to close out a transaction. And since they're often not quoted directly, you need to make sure you understand what they are and how wide they are before doing a trade. Be wary of the mid-market price as your guide, particularly in less liquid stocks. So lessons for investors would be what from part 1 of this hidden costs, if you like, series? Well, first of all, any assessment of the total cost of doing a trade must factor in these spreads. The more often you trade, the more often you'll be hit, so the drag on your overall portfolio performance could be significant. And always challenge the mid-market price. In other words, always say, okay, I understand the mid-market price is a guide, but actually what is the price at which I could either buy or sell, and what will influence the width of that spread going forward? Any questions on an important topic, editor@killick.com, and to watch related videos on topics around share trading, killick.com/learn. And finally, for an electronic copy of my guide, How to Invest in Equities, please email me at the same address, editor@killick.com.